Eh, what happened to this is a bit tricky. Very nice. Okay. Currently, at the moment, it's 3 or 5 p.m. East African timing. GMT plus 3. We are trade Euro refinancing rate, and it's going to be very interesting because of the volatility we do anticipate to come out in the next 9 minutes or so. So, once again, welcome to the channel. So, this is not financial advice, this is just me being me, finding opportunities in the marketplace, and I want you to be a part of this trading session for today, whereby we are going to be trading New York session. Currently, the market, the New York session has begun. And looking at the charts, there has been a lot of quite a significant amount of activity ever since the day did begin. Today, the date is going to be the 5th of June. Now, looking at Euro, one interesting thing is they have been lowering their rates. The last meeting they had, they lowered their rates. We are anticipating them to lower their rates today also. I would want to focus on the press conference at 3:45 because this is where we get the clues, we get the inside of what made the panel lower the interest rates. What do they think about the future economic projections? We want to listen to the president. We want to listen to her, what she's going to say, and I'm paying quite a significant amount of focus to the conference. But in the meantime, in the next 7 minutes or so, we are going to give basically liquidity is about to come into the marketplace, and you want to trade liquidity. My weapon of choice today, I would want to focus on gold against the euro. That is going to be my asset of choice for today. Quite the interesting amount of activity we will be anticipating. So if you're new to the channel, consider subscribing. Look at my previous episodes. You will get an in-depth view of how I look into the marketplace. So these mini episodes, these live streams will really mean a lot in terms of learning it live, executing the markets live is a very different experience, if I can say, because it's an emotional journey. Sometimes you'll get it right, sometimes you won't get it right. But the most important thing is you learn and then you document in a way whereby you cement yourself, you cement your belief, and you execute your plan. That's the most important thing. So I'll be anticipating a short-term investment on gold. So this is going to be the plan of the day. I'll anticipate a short-term retracement to the 50% region. So my analysis is going to be on USD, but I will want to take it on the euro. Basically, they are more or less the same. Actually, the same. I'll want to wait for prices to come back into this region here. This will be my region of interest whereby price this is like 100 points away. Technically, say 100 pips, 100 points, 1,000 points, 100 pips on gold. Quite a good tradable range that you can be executing in the marketplace for a further continuation to the upside. Which again, these highs that we can know tomorrow is going to be non-payroll. I would also want to be cautious because usually after NY open on Thursday, most of the time the market dies off, liquidity is low, the market enters a period of consolidation, anticipating the non-farm payroll come out tomorrow. So today, ECB main refinancing, but tomorrow is the highlight of the week, whereby we do anticipate employment numbers in the United States. The previous two releases have been very healthy in terms of job creation in the United States of America. And we ask ourselves, will this be the beginning, maybe, of the United States gaining market? We have been seeing going sideways against assets like gold, technically, so to say, for the past 2 3 days. And yes, we did have a massive spike today, but we generally ask ourselves the question, if you look at it on a daily time frame, we are in the middle of this leg from the most from the most recent highs that were created and the most recent lows that were created in the marketplace. So we could say the market is in between. We are waiting for that data coming for the employment data as ourselves. Did tariffs have an impact on the employment numbers? Consider the previous two numbers have come out really healthy. Now, employment is very important because the more people are employed in a specific country, the less of the government is going to use in terms of finances to sustain the economy. Because if people are working, it means taxes are going to be collected. Now, taxes is what builds up an economy whereby you can proudly say that you are in a country where the economy is being that is important when you're looking at it in the financial markets. Now, it never shoots straight like an arrow. And that's the good thing about the financial market. So you have to take one pair which is performing really good and one pair that is not performing really good. The differences between who's weak and who's stronger, that's where the money is made. We will be anticipating 127,000 jobs to be created in the month of May. So this is the last month's data. And unemployment rate constant, it usually fluctuates between the 4.1 and the 4.2%. Quite healthy. Average hourly earnings, we do anticipate a slight increase with focus at 0.3%, comparing to a previous 0.2% for last month's release data. Is very interesting. Going back to XAUSD, we do have less than 10 minutes. Oh, the release. Let's see what's going to happen. Should we look at Euro USD? Oh, no, I'm going to stick to this darling amount. Okay, 1 minute to go. But remember, the highlight is going to be the press conference. That's where I want to put majority of the focus on these live streams. Remember, if you enjoy the stream, don't forget to consider subscribing. So, beautiful day. What a wonderful day. Now, looking at price action, very interesting. We did have, now I was looking at this candlestick. I started paying attention to the focus whereby this candlestick had already started printing. And the most important thing I was asking myself is usually you never get three candlesticks printing bullish on the 1 hour. I like focusing on the 1 hour on gold so much. It's very rare to get three candlesticks printing with such momentum. Very rare. So when I did see these candlestick retracing, I was asking myself, okay, could we find support somewhere around this region? Look for further continuations to the upper 3 seconds again. Okay, taking its time. Now interest rates are very interesting. Okay, so it's come out as the focus to 2.15%, which was what we had anticipated. Now the next thing will be wait for in the next 30 minutes. We are going to have the press conference. That's the most important thing we will going to pay attention to today. So quite some volatility in the marketplace, which is good. Which is good. This is whereby you sit on your hands still. You wait for the opportunity to come to you. Let's look at the policy statement. They're going to read it for us. Okay, it's still not yet been released. But okay, here it is. So this is from the European Union. So this is a government document. Okay, the governing council today decided to lower the three key ECB interest rates by 25 basis points. In particular, the decision to lower the deposit facility rate, the rate through which the governing council steers the monetary policy, is based on its updated assessment of the inflation outlook. Very interesting. The dynamics of underlying inflation and the strength of monetary policy transmission. So inflation is currently at the governing council's 2% median target rate, which is good. That's usually the central bank's target range in the baseline of the new Eurosystem staff projections. Headline inflation is set to average 2% in 2025, 1.6% in 2026, and 2.2%, okay, an increase in 2027. The downward revisions compared with the March projections by 0.3 percentage points for both 2025 and 2026 mainly reflect lower assumptions of energy prices, okay, and a stronger euro. Staff expect inflation excluding food and energy to average 2.4% in 2025 and 1.9% in 2026. Interesting. Broadly unchanged since March. So you can read through the whole document. They're going to read it for us in the press conference. This is what they're going to start with. But we want to look at the keywords. So inflation is coming down. What they do anticipate actually in 2026 inflation will come down much further, but a slight pickup in 2027. This is hence the reason for lowering the interest rate. Now, whenever a central bank lowers the interest rate, what they mean is actually they are weakening the economy. They are trying to stimulate the economy, whereby they're looking at things like, okay, tomato prices are good, everything is good. Now we can make loans much cheaper because with the low interest rates, it encourages people to start borrowing loans, to invest and spend in businesses and so on and so forth in the financial marketplace. That is the purpose of, that's one of the purposes of the central bank. It looks at inflation and it looks at the people. Okay? Now, by the people, I mean the financial system of whereby they look at, okay, the economy is at a certain level. If we do lower interest rates, We're encouraging people to come take out loans. But at the same time, it weakens the economy. Why? Because it makes government issued bonds and treasuries much less appealing because there's going to be a much lesser return in terms of treasuries and bonds sold by the government of that specific country. In this particular example, we are talking about the Eurozone. Now, when you look at the Eurozone, very interesting. When you look at countries like Germany, when you look at European at large, they do have really good products. When you look at their automotive sector, agricultural sector, industrial sector, they are quite advanced. And what they are trying to do, especially in the Eurozone, is to stimulate the economy, whereby they've been looking at things, okay, we are doing good, we're doing good, but we can actually make it better for our own people. Now, there are, of course, other certain things in the marketplace whereby, when you look at, for example, Donald Trump came about with the tariffs unexpected, and it was a shock. When you look at assets like the Nasdaq, look at assets like let's take a look at Nasdaq for a while. I can go to the 4 hour time frame. There was a period whereby it was very worrying, starting January of this year, somewhere around January of this year, and we did see the Nasdaq lose quite the percentage. Actually, if you look at it from the 20th to somewhere around 7th April, the Nasdaq rose. I do believe it did trigger the 30% threshold, whereby people started asking questions of, are we in a recession? Where are we headed in the marketplace? And then we had one of the best recoveries of the Nasdaq in around 58 days, gaining about 32% of the total index, meaning the US, like the United States, is still in the game, but for how long? And the most important question we ask ourselves is, could there be more to this bullish run? That's the purpose of trading, like looking for opportunities. Huh? You ask yourself, okay, where have we come from? Where are we at? And where are we likely most headed to? Now, it reaches a point whereby everything works. Huh? It's all about probability. Forex is all about probability. And it's a piece of the pattern. 1 plus 1 plus 1 plus 1 plus 1. The equation never ends. Huh? And it doesn't matter if you're right or wrong. The most important thing is, can you stay in the game for long enough, keyword long enough, so that the probabilities play out in your favor. Yep, very interesting. As we wait for 345, because I'm looking to find opportunities around 29.61. So stop loss is going to be very subjective. Currently, at the moment, it's 322. What I'm anticipating is this market will, so the 4 hour time frame. Okay, now this is one thing I need to do. As you can see, sometimes it doesn't match. So I tend to pick the one that ends at 4. Okay, so I'm going to stick with this broker. Look at the same. That's something interesting to note out also. Okay, yeah. So this is the broker because it aligns with the time of my broker. And then I was looking for something I thought I could find it. Oh, a massive retracement on the 4 hour time frame, which is good. We are currently rejecting this region. Maybe come back down for a retracement for a further continuation to the upside. And this is one thing I'll be very interested in, the pullbacks. I like trading the pullback. So you're anticipating prices to come back down slightly for you to find opportunities to the upside. What a wonderful day. Okay, so we're back here. Okay. In the context of high uncertainty, staff also assessed some of the mechanisms by which different trade policies, very interesting, could affect growth and inflation under some alternative illustrative scenarios. These scenarios will be published in the staff predictions on the ECB's website. Under this scenario analysis, the further escalation of the trade tensions over the coming months will result in growth and inflation being below the baseline projection. Wow. By contrast, if trade tensions were resolved with a benign outcome, growth and to a lesser extent inflation will be higher in the baseline than in the baseline projection. Most measures of underlying inflation suggest that inflation will settle around the governing council's 2% median target on a sustained basis. Wage is still elevated but continues to moderate visibly, and profits are partially buffering its impact on inflation. It makes me think of what I'm buying. I want to buy yeah, something from Europe, a European machine. They have really good products. I like Europe. I like Europe so much, especially being a car enthusiast. When you look at and this is one thing Trump is fighting against, whereby European, the biggest marketplace is the United States. When you look at the US buy a lot of German machinery, European machinery. When you look at even the motorbikes, when you look at bikes from like the Ducati, wow, beautiful, beautiful pieces of machine. The Lamborghini, the BMW, like countless models of cars, and they're all unique on its own part. They've been doing it for the same pace, and on one of my recent streams, Trump was also saying that companies like Rolls Royce are going to benefit from some of the new government policies that they had enacted in terms of trade, whereby Rolls Royce will now export to the United States much more efficiently, and they will also have some tax benefits. It's all about the taxes, technically speaking. So, looking at it, they're trying to fight off also what China does because China has sort of mass production. So, when you look at Rolls Royce, they build a limited production number. When you look at the high end vehicles, but when you look at China, on the other hand, all of them, they do deal with mass production, hundreds of thousands of units, which come in at a very low price, which makes it tempting for the customer. For the customer, it really tempts because if you look at it, you cannot compare the price of a Rolls Royce, something made in Europe and something made in China. Technically speaking. So it's always a fight of customers, so to say, the producers and the consumers, because there are good products out there. Now, the better the product and the more it goes to consumers, the more money is going to be circulated in certain regions. So, when I want to focus on euro today, especially looking at the inflation numbers for tomorrow. Remember, one plus one plus one. Okay, so fundamental analysis is very interesting. It's a piece of a puzzle. It's not even tricky, so to say. It's a very interesting puzzle whereby you try to put in pieces to make decisions to help you make better decisions in the financial. For me, I focus a lot on technical analysis. My technical analysis is very simple. I usually focus on macroeconomics, fundamental analysis, but most importantly, I look at fear because I trade gold, and gold is very fearful. Not the metal itself, but gold is emotional. That's the best word to use. Gold is emotion. Whenever people are fearful, they buy it. Whenever people are confident, they sell it. Supply and demand. We have 15 minutes to go. Let's more or less 15 minutes to go for the conference, and we want to listen to what the Presidente will say. Very good, a very good job, a very decent job. When you look at Jerome Powell, like being a president of a central bank is quite a responsibility. Yeah, the how can I put it? It's a panel that is responsible for millions and billions and trillions. When they say they lower rates, they lower rates. Okay. So prices is behaving nicely. The world want you to be. I want you to go down. So more or less 60 pips away from my entry price. Yeah. So the document ends by the president of the ECB comment on the considerations and like these decisions at a press conference starting 14:45 today. Our local time it's going to be 3:45. So right now they are doves. We are not hawkish. We are dovish. Interesting. Most terminologies are very interesting. Hawkish and dovish. So doves favor the people, the hawks favor. It's a very interesting phenomenon. Like I remember when I was starting forex, and then my mentor explained to me the hawkish because I was like, "What do you mean by hawkish? What do you mean by dovish?" And then he explained to me, and I was like, "Yeah, like, yeah, both are birds, eh? But damn, it was just very interesting." So right now we meaning we are favoring lower interest. Mm, what's happening to my audio? Because I can't hear this. There's no proposals. I like watching Nick also. So it's a stream about a stream. I don't know why. Mhm. Just a moment.
Weakness for the US jobs
Here
market,
here it
then
is.
yes, there's a good chance that I think the Fed is behind the curve and needs to cut interest rates soon. But we don't know the NFP report just yet. But this unemployment claims is not great. having a 242 back to back higher than expected unemployment claims numbers. This is a weekly number that comes out. We were expecting, well, let me pull this up. So we don't have the data point just in yet, but we will have it soon within the Edge Finder. It will update in here. But guys, what this is going to look like today is this is going to go up to here. That's how that's going to look once it populates. But what you can see here is that that is 2 back-to-back weeks where unemployment claims are rising more than people expected. Some contraction in the labor market seems to be happening. And that's also following yesterday's very poor ADP numbers. So here's the thing. What people will constructively do is say, this is Powell's fault if you're heavily right leaning. And then people say, this is Trump's fault if you're heavily left leaning. Whose fault is it? Who cares? We're traders. We don't care about that, right? Don't sit there and dwell on politics all day long. If you're actually trading the market, let's just trade what's in front of us, right? Sure, you can throw blame. You can stare at, media all day long about who did what and whose fault it is. But as a trader, that doesn't really do anything for you. And biasing your trading heavily is a really dangerous path to go down. So let's just look at the stats. Okay. So this week, unemployment data, this is all very bearish in my view for the dollar index. To me, this suggests rate cuts are coming. This suggests that the probabilities that we're going to get rate cuts increase. Now, for the stock market, it's not a super positive indicator because we might be getting rate cuts because the economy is contracting, right? But take a look at the response to this in the metals market. The gold and silver. I mean, did you guys see silver? Silver. Who said that? Somebody just said that in the chat. Have you seen silver, Nick? Yeah, look at silver. Look at this breakout. Huge breakout, right? Really impressive move higher. 34.7 was the previous high. And this is, by the way, this is a multi-year high right here for silver. It's not the all-time high. All-time high here, I believe, is actually, it's back in 2008, 2010, 2011. So we had a really big move higher here today. That's a beautiful, beautiful candle in terms of a weekly chart view for silver. Really strong breakout. You can see the last couple of days, wicked higher, and then off to the races today. This is a really bullish thing for metals because not only do you have silver moving higher, you have gold moving higher. And what I like to see in terms of like a confirmation is when silver is leading gold. To me, that's a really good indicator of metal strength. And so I'll tell you what, guys, this is making me a little bit more interested in watching metals. Just slightly more leaning into, okay, so gold and silver, I believe silver has a neutral reading, but what does gold have? Where's gold at? Ooh, gold has a bullish reading. Interesting. Okay, so gold has a bullish reading. Some of the this week has not been this week has not been good for economic data. In fact, this week I've gradually shifted. I mean, you know what? Let's just pull it up. We've got the data. Why not use it? The economic heat map. See all the yellow text, guys? So if you're an Edge Finder user, if you see the yellow text, what the yellow text tells you is that in the last 7 days, this number was reported. So you can see this week has been heavy on the economic data side. Quiet Minute says gold is very bullish in the Edge Finder. Yeah, I see why. I see why, guys. Gold's starting to look good again because, again, this is why I say stay systematic. If you were watching the show in recent times, right, you may have heard me say I'm kind of neutral on gold, neutral on the dollar. When I say I like to be systematic, this is why. The data this week requires me, based on my trading system, to acknowledge the data. It doesn't matter if I think, I want something to be bullish or I want something to be bearish.
So this is why I love watching Nick, because he's a fundamentals guy like I am. And sometimes it's good looking at other people's opinions, other people you can relate with. Like that's the only person I look at his live streams, and it's very interesting to be following what other people are also doing in the financial market. But we want the ECB refinancing. Okay, I do believe. Okay, here we are. Here we are. As we wait for that in the next 5 minutes. So this is the European timing. Let's see. Let's see. Mhm. 2 minutes to go. Once again, the plan is waiting for price to come back down. Okay, so we are less than 40 pips away from our point of interest, whereby we're going to look at opportunities somewhere around this region here. But I want to get a clear confirmation that there is a change in state of delivery. So we're going to see a three candlestick chart pattern. What we're going to see in this marketplace play out is something of this nature. So this is the pattern I'm waiting for. Now, I'm willing to have it also. So I can hold the drawdown. So this is the pattern I'll be waiting for. Okay, let's adjust this. Go back. European timing. Very interesting. So this is what we want to see.
Good afternoon and welcome to our press conference with President Lagarde and Vice President de Guindos.
Yes, ma'am.
And my name is Wolfgang Preußel.
Yes,
We
sir.
have journalists participating online, so when I give them the floor, please turn on your camera and your microphone. And with that, I hand over to President Lagarde, please.
Thank you very much, Wolfgang, and good afternoon to all of you present, and good day to all those who are online from somewhere in the world. The Vice President and I welcome you to our press conference. And the Governing Council today decided to lower the three key ECB interest rates by 25 basis points. In particular, the decision to lower the deposit facility rate, the rate through which we steer the monetary policy stance, is based on our updated assessment of the inflation outlook, the dynamics of underlying inflation, and the strength of monetary policy transmission. Inflation is currently at around our 2% medium-term target. In the baseline of the new Eurosystem staff projections, headline inflation is set to average 2% in 2025, 1.6% in 2026, and 2% in 2027. The downward revisions, compared with the March projections by 0.3 percentage point for both 25 and 26, mainly reflect lower assumptions for energy prices and a stronger euro.
Okay. I like what's happening.
Staff expects inflation,
Yeah.
excluding energy and food, to average 2.4% in 25
is
and
news trading for you.
1.9% in both 26
that.
and 27, broadly unchanged since March. Staff see real GDP growth averaging 0.9% in 25, 1.1% in 26, and 1.3% in 27. The unrevised growth projection for 2025 reflects a stronger than expected first quarter, combined with weaker prospects for the remainder of the year. While the uncertainty surrounding trade policies is expected to weigh on business investment and exports, especially in the short term, rising government investment in defense and infrastructure will increasingly support growth over the medium term. Higher real incomes and a robust labor market will allow households to spend more. Together with more favorable financing conditions, this should make the economy more resilient to global shocks. In the context of high uncertainty, staff also assessed some of the mechanisms by which different trade policies could affect growth and inflation under some alternative illustrative scenarios. These scenarios will be published with the staff projections on our website. Under this scenario analysis, a further escalation of trade tensions over the coming months would result in growth and inflation being below the baseline projections. By contrast, if trade tensions were resolved with a benign outcome, growth and to a lesser extent inflation would be higher in the baseline projections. Most measures of underlying inflation suggest that inflation will settle at around our 2% medium-term target on a sustained basis. Wage growth is still elevated, but continues to moderate visibly, and profits are partially buffering its impact on inflation. The concerns that increased uncertainty and a volatile market
News
response
usually
to the
grabs
trade tension
liquidity,
in April
and then the
would have
continuation
a
continues
tightening
on.
impact on financing condition
So that's what
have
I'm
eased.
anticipating.
We are determined to ensure that inflation stabilizes sustainably at our 2% medium-term target, especially in current conditions of
So we have
exceptional
8 minutes for
uncertainty.
this 1 hour
We
candlestick
will
to
follow
close.
a data-dependent and meeting-by-meeting approach to determining the appropriate monetary policy stance. Our interest rate decisions will be based on our assessment of the inflation outlook in light of the incoming economic and financial data, the dynamics of underlying inflation, and the strength of monetary policy transmission. We are not pre-committing to a particular rate path. The decisions taken today are set out in a press release that is available on our website. So I will now outline in more details how we see the economy and inflation developing, and will then explain our assessment of financial and monetary conditions. The economy grew by 0.3% in the first quarter of 2025, according to Eurostat's flash estimate. Unemployment at 6.2% in April is at its lowest level since the launch of the euro, and employment grew by 0.3% in the first quarter of the year, according to the flash estimate. In line with the staff projections, survey data point overall to some weaker prospects in the near term. While manufacturing has strengthened, partly because trade has been brought forward in anticipation of higher tariff, the more domestically oriented services sector is slowing. Higher tariffs and a stronger euro are expected to make it harder for firms to export. High uncertainty is expected to weigh on investment, but at the same time, several factors are keeping the economy resilient and should support growth over the medium term. A strong labor market, rising real
This is a
incomes,
strategy I like using so much.
robust
It's
private
called
sector
AMD.
balance sheets, and easier
Accumulation,
financing
manipulation, then
conditions,
distribution.
in
So the
part
markets
because
have
of
been
our past
accumulating.
interest rate cuts, should
We are now
all help
manipulating. We are waiting
consumers
for the
and
distribution.
firms withstand the fallout from a volatile global environment. Recently announced measures to step up defense and infrastructure investment should also bolster growth. In the present geopolitical environment, it is even more urgent for fiscal and structural policies to make the euro area economy more productive, more competitive, and more resilient. The European Commission's Competitiveness Compass provides a concrete roadmap for action, and its proposals, including on simplification, should be swiftly adopted. This includes completing the Savings and Investment Union, following a clear and ambitious timetable. It is also important to rapidly establish the legislative framework to prepare the ground for the potential introduction of a digital euro. Governments should ensure sustainable public finances in line with the EU's economic governance framework, while prioritizing essential growth-enhancing structural reforms and strategic investment. Looking at inflation, annual inflation declined to 1.9% in May, from 2.2% in April, according to Eurostat's flash estimates. Energy price inflation remained at minus 3.6%. Food price inflation rose to 3.3%, from 3% the month before. Goods inflation was unchanged at 0.6%, while services
I'm going to wait for this
inflation
1 hour candle to
dropped
close in
to
the next 4 minutes.
3.2% from 4% in April. Services inflation had jumped in April mainly because prices for travel services around the Easter holidays went up by more than expected. Most indicators of underlying inflation suggest that inflation will stabilize sustainably at our 2% medium-term target. Labor costs are gradually moderating, as indicated by incoming data on negotiated wages and available country data on compensation per employee. The ECB's wage tracker points to a further easing of negotiated wage growth in 2025, while the staff projections see wage growth falling to below 3% in 2026 and 2027. While lower energy prices and a stronger euro are putting downward pressure on inflation in the near term, inflation is expected to return to target in 2027. Short-term consumer inflation expectations edged up in April, likely reflecting news about trade tensions. But most measures of longer-term inflation expectations continue to stand at around 2%, which supports the stabilization of inflation around our target. Turning now to our risk assessment. Risks to economic growth remain tilted to the downside. A further escalation in global trade tensions and associated uncertainties could lower euro area growth by dampening exports and dragging down investment and consumption. A deterioration in financial market sentiment could lead to tighter financing conditions and greater risk aversion, and make firms and households less willing to invest and consume. Geopolitical tensions, such as Russia's unjustified war against Ukraine and the tragic conflict in the Middle East, remain a major source of uncertainty. By contrast, if trade and geopolitical tensions were resolved swiftly, this could lift sentiment and spur activity. A further increase in defense and infrastructure spending, together with productivity-enhancing reforms, would also add to growth. The outlook for euro area inflation is more uncertain than usual. As a result of the volatile global trade policy environment, falling energy prices and a stronger euro could put further downward pressure on inflation. This could be reinforced if higher tariffs led to lower demand for euro area exports and to countries with overcapacity rerouting their exports to the euro area. Trade tensions could lead to greater volatility and risk aversion in financial markets, which would weigh on domestic demand and would thereby also lower inflation. By contrast, a fragmentation of global supply chains could raise inflation by pushing up
So
import
the 1 hour is
prices
starting.
and adding to capacity constraints in the domestic economy. A boost in defense and infrastructure spending could also raise inflation over the medium term. Extreme weather events and the unfolding climate crisis more broadly could drive up food prices by more than expected. Let's look at the financial and monetary conditions. Risk-free interest rates have remained broadly unchanged since our last meeting. Equity prices have risen, and corporate bond spreads have narrowed in response to more positive news about global trade policies and the improvement in global risk sentiment. Our past interest rate cuts continue to make corporate borrowing less expensive. The average interest rate on new loans to firms declined to 3.8% from 3.9% in March. The cost of issuing market-based debt was unchanged at 3.7%. Bank lending to firms continued to strengthen gradually, growing by an annual rate of 2.6% in April after 2.4% in March, while corporate bond issuance was subdued. The average interest
I'll
rate
read
on
for the
new
first 5
mortgages
minutes.
stayed at 3.3% in April, while growth in mortgage lending
I would like to
increased to
find an opportunity
1.9%.
at 4 or 5.
In line with our monetary policy strategy, the Governing Council thoroughly assessed the links between monetary policy and financial stability. While euro area banks remain resilient, broader financial stability risks remain elevated, in particular owing to highly uncertain and volatile global trade policies. Macroprudential policy remains the first line of defense against the buildup of financial vulnerabilities, enhancing resilience and preserving macroprudential space. So in conclusion, the Governing Council today decided to lower the 3 key ECB interest rates by 25 basis points. In particular, the decision to lower the deposit facility rate, the rate through which we steer the monetary policy stance, is based on our updated assessment of the inflation outlook, the dynamics of underlying inflation, and the strength of monetary policy transmission. We are determined to ensure that inflation stabilizes sustainably at our 2% medium-term target. Especially in current conditions of exceptional uncertainty, we will follow a data-dependent and meeting-by-meeting approach to determining the appropriate monetary policy stance. Our interest rate decisions will be based on our assessment of the inflation outlook in light of the incoming economic and financial data, the dynamics of underlying inflation, and the strength of monetary policy transmission. We are not pre-committing to a particular rate path. And in any case, we stand ready to adjust all of our instruments within our mandate to ensure that inflation stabilizes sustainably at our medium-term target and to preserve the smooth functioning of monetary policy transmission. We are now ready to take your questions.
And the first question goes to Mark Schröers of Bloomberg. Mark, please.
Yes, thanks a lot for taking the questions. The first one is on rates. Has anyone today advocated either pausing rate cuts or cutting by a bigger 50 basis points? And would you say that after today's rate cut to 2%, a pause at the next meeting in July would make sense, also to wait for new projections in September? And the other one is not on the future of rates, but on your own future. WEF founder Klaus Schwab had said that you discussed leaving the ECB before the end of your term to lead the World Economic Forum. I know the ECB stated your determination to stay, but without an outright denial of these talks. So have these talks taken place or not? And have you contemplated leaving the ECB early? Thank you.
Thank you for your two questions. And I'll start with the first one, which is really the order of business and the main topic today. So we cut interest rates by 25 basis points. And with today's cut at the current level of interest rates, we believe that we are in a good position to navigate the uncertain conditions that will be coming up. So we are well positioned to navigate those circumstances. I can also tell you that it was an almost unanimous decision. There was one governing council member who did not support the decision, but other than that, it was virtually unanimous. So I would call it either very broad consensus or virtually unanimous support for the decision to cut by 25 basis points. And obviously, we analyzed the situation in the light of the three criteria that you know well, because they are repeated several times in the monetary policy statement and have not varied for a number of meetings now. But under those three criteria, really the situation points towards inflation settling at our 2% targets. We can come back to the path, but this is what we are seeing, and that is what has predicated the cut that we made today. Now, you asked me about my future, which is far less important than the future of the economy and the future of our monetary policy, rest assured. But I can very firmly tell you that I have always been, and I'm fully determined
About to be
to
stopped
deliver
off.
on my mission, and I'm determined to complete my term. So I regret to tell you that you're not about to see the back of me.
Next question goes to Annette Weisbach of CNBC. Annette, please.
Hi, President Lagarde. I have a question. When I read through the communique today, I have the feeling that you're quite confident on the economy despite all the uncertainties. So is that a right assessment? And at the same time, you're also quite confident that inflation is under control. So does that bring me to the right conclusion that we're almost done when it comes to rate cutting? And then a question on your thinking about the boost
Let
from
me
the
add other
fiscal space,
positions on my
because clearly it
device.
will take time until we'll see that materializing on the economy and also probably on inflation. So just to also understand, why are you so confident that this is actually supporting the economy also in the shorter term, despite all the uncertainties? Thank you.
Well, thank you so much for your question. We have hardly revised our growth numbers. So the only year where we have slightly revised is 2026, and by 0.1%. So we have confirmed our projected growth rate as per our projection of last March at 0.9% for 2025. And that was certainly reinforced by the number we had for Q1. So I mentioned the 0.3 Q1 number, which was, as you know, revised from an initial 0.4. I would not exclude that there be further revision of that number on the upside. Now, this is attributable to multiple factors. It's improved consumption, it's improved investment, but more importantly, it's the buildup of inventory or anticipated purchases and therefore sales in fear and anticipation of the tariffs. So that Q1 is, of course, very peculiar, very particular, more than peculiar, and is clearly giving momentum to the growth that we are seeing and anticipating for 2025. But again, I would not exclude that that number of 0.3 be revised upward, given the volume that we are seeing being traded out of some countries in particular. But we are not revising 27, and we are very marginally revising 2026 because there is a carryover, number one, and because we believe that the impact of tariff, if and when they materialize, on the export that we have towards the United States, which I remind you is only 17% of our total exports outside from the euro area and European countries, will impact predominantly on 26 and will then be significantly offset by the expected investment in both military equipment and construction, or infrastructure, if you will, particularly out of some
Gold
countries.
dollar is
So
behaving much more
our
than
assessment
XP
is
euro.
that that will have a bearing on 27 predominantly, some in 26, but predominantly in 27. So you have this offset between the two. So are we confident? I think that would be far-fetched, because we are in a good place. As I said, I think we are well positioned as you know, after that 25 basis point rate cut and with the rate path as it is. We are in a good place. We will face uncertainty. We do not know what the outcome of the negotiations will be between the various partners. We don't know the level of retaliation that might be decided, which incidentally is not included in our baseline, as you will see published later on. And as a result, we have to be prepared, and we will be assessing meeting by meeting data as they come in. But you know, as I said again, we are well positioned at the moment, and the path of inflation that we see certainly returns to 2% in 2027. So we start from a place where we have inflation for 2025 at 2%. It goes below target in 26 for reasons that have predominantly to do with the price of energy and the value of the euro. Because as you know, it's based on our current assumption of those prices now. And that's what explains these numbers.
Next question, Francesco Canepa of Reuters. Francesco, please.
Thank you very much. Good afternoon.
Good afternoon.
So you said that the current level of rates leaves you in a good position.
Mm-hmm.
Are we to understand that as an indication that you're done cutting interest rates? Or if I can rephrase the question in another way, what would you need to see for you to cut rates again?
Again, we are in a good position, and we are in a good position on the basis of the current rate path and with the 25 basis point cuts that we decided, so that we can face the uncertainties that are coming our way. But as you have heard in the monetary policy statement, we will decide meeting by meeting on the basis of data. And we will assess, as and when data come in, whether or not that position is secure in order to deliver on our 2% medium-term target. What I'm saying today is that we are in that good position.
Next question to Aude Kersulek of BFM Business. Aude, please.
Thank you, President Lagarde, for taking my question. First question, would you say the monetary stance has now shifted to neutral, or is it still restrictive, even slightly? And the second question, some countries are facing higher debt and may struggle to attract investors. At what point does that become a concern for the ECB in terms of policy transmission and financial stability? Thank you.
Well, thank you for your two questions. We have not discussed this wonderful concept of the neutral rate on the occasion of this meeting. And I think that we all know well that as we are getting closer to that zone, we need to be particularly attentive. We need to be confident in our resolve to deliver with the appropriate monetary policy our medium-term 2% target. But we have not discussed that neutral rate. And I alluded to that at our last press conference. You know, the neutral rate is predicated on the absence of shock. Great equilibrium, no shock. Well, I wish there was no shock. But we have just nearly concluded a cycle of monetary policy that dealt with a series of shocks. Pandemic,
Sort of.
war in Ukraine, energy crisis.
So,
And I think we have done that decently well. Inflation is at target 2% medium term. We are currently around 2%. Expectations are well anchored around 2%. And those elements that I told you repeatedly over the few last
gold,
conferences
dollar,
was of concern to us,
XAUSD
namely
behaved.
inflation on services,
Yeah.
evolution of wages, evolution of profit. Those three elements are coming really in line with what our projections were in order to deliver on our 2% medium-term target. For the moment, we are facing significant uncertainty. You will read in the material, in the monetary policy statement, I think we quote uncertainty 9 or 10 times. It abounds. There is plenty of that. And clearly we are trying to improve our game as much as we can in order to
I'm still in
anticipate, measure, caliber, but it's proving obviously quite difficult. And that's the reason you will be not only receiving our projection exercise, but also the scenarios which encapsulate some of the channels of transmission to growth and inflation. Some of them, not all of them. In particular, I would mention one that we discussed quite extensively during the Governing Council, which is the disruption of the supply chain. That is not included in any of our scenarios.
And the next question goes to Svein Ilyan of the Bulgarian newswire BTR.
Oh, welcome.
Thank you.
I hope all your colleagues have welcomed you to the circle.
I hope to. According to the ECB convergence report published Wednesday, Bulgaria is ready to join the Eurozone on January 1st next year. What do you expect to be the effects of Bulgaria's accession to the euro area? And will the currency zone be stronger with the likely new member state?
So first of all, I would like to congratulate Bulgaria, the Bulgarian people, and welcome them. This is not yet a completed decision-making process because, as you know, while the Commission and us have validated under the convergence report that the criteria are met, the European Council still has to approve. So I don't want to prejudge what the European Council will decide, but there is a very strong likelihood that Bulgaria will become our 21st member around the table. And we are delighted that the circle gets larger, and we will be looking forward to the Bulgarian contributions, both in terms of intellectual input, economic analysis, monetary policy determination, and as soon as the decision is final with the European Council, as you probably know, we will welcome for several meetings before January 1st, the Bulgarian representative at the table of the Governing Council in order to sort of facilitate and do the onboarding properly, and so that we can also get to know a new colleague. I also hope that the Bulgarian people will value the solidity of the euro area, the solidity of the currency that we have. Some of you have probably noticed that the supportive judgment of the Europeans, has gone up and is now at 83%. So you have 83% of the Europeans, based on a survey that is done on a regular basis, 83% actually value and appreciate the euro as their currency. So I hope we can together do everything we can so that Bulgarians can also appreciate the value and the shield impact that the euro constitute for new members.
And the next question
It's
goes
very
to
painful.
Stefan Recchius of Handelsblatt.
This trade decided to stop me out.
Thank you very
It's
much for the
actually
floor.
crazy.
First question is, some analysts have entertained the
But
idea
it
that
happens.
you could skip July to make a concession to those governing council members who have already become reluctant to cut rates further. Could you walk us through today's deliberations in this light? And my second question is, you have been reluctant to declare victory over inflation for quite some time. So is this the right time for a victory lap? And if not, why?
Yeah, victory laps are always nice, but there is always another battle. So, you know, as I said, I think that with today's cut and the current level of interest rates, number one, I think we are getting to the end of a monetary policy cycle that was responding to compounded shocks, including
Hey,
COVID,
gold.
including the war in
Gold
Ukraine,
dollar played
the
nicely.
illegitimate war in Ukraine,
Really
and
nicely.
the energy crisis. But of course, we are now into a different
Gold euro. Gold euro
different
did me
time
dirty.
with different players, with different partners, with different policies. And we will continue to analyze and assess and measure and make sure that we deliver on our 2% medium-term target. This is in a way the thing that is certain. You should not doubt for a second our determination to deliver with the appropriate
Almost
monetary policy,
I entered at
the
33.
2% medium-term target.
35.
What we're seeing currently with this, 2% projected inflation for 2025, around 2% for 2027,
No
and
stop loss.
1.6 in 26, caused predominantly with our current assumption on the price of energy and the value of the euro. We have a good path to this target, and we'll make sure that we I don't mean to use the word oscillate or navigate, but it will be, close navigation around our target. That's where we have to be and want to be.
Next question to Olaf Storbeck of the Financial Times. Olaf, please.
Thanks. My first question is on this concept of the direction of travel, which you earlier used in this rate cycle. Your today's remarks suggest to me that the direction of travel now probably is more a sideways movement rather than kind of a downward as it was by the end of the year. Would that be the right takeaway from your today's remarks? And my second question again is on these remarks by Klaus Schwab of the World Economic Forum. Some people suggest that the disclosure that you considered leaving the ECB early could undermine your ability to do your job properly, as you might be seen as a lame duck. What would be your response to those concerns? Thanks.
Thank you for your two questions. On the first one, the reason I used the direction of travel concept was when we were really at a distance from our medium-term 2% target. So to talk about the direction of travel, when we have our medium-term 2% target in sight, sustainably so, when underlying inflation is not budging. So for those in doubt, headline inflation in 2026 is clearly oil and gas and the value of the euro, which we assess at the time when we cut off the period when we do our when staff does its assessment. And underlying inflation, core inflation, this is hardly moving, and it's at around our target. So there's no point talking about the direction of travel. There's no point talking about sideways. What I'm saying is that we will be determined to deliver that 2% medium-term target. We will be looking at all data that come in. We will be deciding meeting by meeting, and we will constantly assess and reassess how we are delivering on this 2% medium-term target. As to your second question, I will repeat what I have said. I have always been driven by my mandate, and I'm determined to complete my term. Period.
And the next question goes to Isabella Bufacchi of Il Sole 24 Ore. Isabella, please.
Thank you for the opportunity. I have two questions. One is on APP and PEP, in the sense that the ECB no longer reinvests the principal payments of these portfolios. Would the Governing Council have to put on hold quantitative tightening if it were to decide for a pause in interest rate cuts? Even if these no longer investments have a very small impact, keeping interest rates unchanged during QT is somehow a restrictive stance, as the ECB is draining liquidity. And my second question is on the role of the euro. The governor of the Bank of Italy, Fabio Panetta, warned in his speech on the 30th of May, in his concluding remarks, that the recent US depreciation raised important questions about the future structure of the international monetary system and the dominant role of the US dollar as both a reserve and a trade invoicing currency. I would be very interested to know your opinion, given your vast and very important special experience in the United States. What do you think is happening now with the dollar, and also what could be the implications for us, for the role of the euro, and hopefully also euro-denominated safe assets? Thank you.
That's like 4 questions in 2. So on your first question, while I appreciate that some of you would like to hear me talk about pause, hold, or whatever, I just can repeat myself that we are currently well positioned to navigate the uncertainties of the next months. And I think the risk of inconsistency anyway is not, sorry, the risk of inconsistency of QT associated with interest rate policy, which is our main tool, is probably less critical in the event that I'm not confirming here now of a pause than it is in the event of a cut. So I don't see that, but neither do I say anything about future decisions, which would only be predicated on major shocks that we are not seeing at the moment. Now, on the role of the euro, I highly regard the speech that was given by my colleague and friend, Governor Panetta, Gentile Governatore, right? And I happen to be very much on the same page as he is. I gave a speech in Berlin about 10 days ago now, at the Hertie School of the Jacques Delors Institute, in which I tried to identify the key pillars that would need to be consolidated and further developed if the euro was to play a critical role as an international reserve currency. And my conclusion is that there is an opportunity that is opening now